What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I have another REIT that I've been buying. I have it in my M1 Finance dividend portfolio. Dividend growth is solid and its revenue is solid. And this dividend growth is very powerful in the past 5 years. So I really wanted to emphasize these guys. I don't think I did an individual video on these guys ever. And I really need to. Again, this is not financial advice. It's for entertainment purposes only, disclaimer in the description. But I have to be very transparent and provide my rationales as to why I love these guys as a dividend stock and why they're a powerful dividend stock. So make sure you hit that notification bell after you subscribe. If you're just new to this channel, make sure you give me a thumbs up. Let's check this REIT out right now. And that REIT is Spirit Realty Capital. I'm pretty sure I have not posted a video on these guys and done an individual review. I own these guys. I'm long in these guys. I'd have to be really surprised at some recent news and really bite the bullet and sell these guys. I'd be very upset to sell these guys if something happened, but they're just so strong. They're so powerful, and they're less than $40. This is why I'm buying more on my M1 Finance dividend portfolio. In my fractional share dividend portfolio, I have a certain percentage, and recent payments, I did buy some shares of these guys. So I'm hoping to get to 100, 200 shares and really let it fly with this dividend income quarterly. The average volume is 1.02 million. The market cap is 5.49 billion US dollars. G range is 34.31 to 48.24. Day range is 38.61 to 39.03. And its previous close was 38.29. Let's check these guys out. They're headquartered in Dallas, Texas. Spirit Realty Capital, the symbol SRC, is a premier net lease REIT, investing primarily in single-tenant, operationally essential real estate assets which are subject to long-term leases. So they partner with businesses across the United States, providing capital that empowers their tenants to expand and evolve. This creates economic growth, benefits communities nationwide, and provides strong returns for their stockholders or shareholders. Remember, 90% of what they make go back to investors who own shares. That's the rule of a real estate investment trust. So they have a few things: growing stream of earnings and dividends. So that's one thing I like. Freestanding single tenant, operationally essential real estate, high quality, diversified triple net portfolio. Let's see how big these guys are. This is what really attracted me to these guys. Usually these guys are pandemic proof and recession proof. So let me go over their portfolio. So this is what makes these guys strong. So remember, like I said, they are single tenant, operationally essential real estate assets which are subject to long-term leases. They continually work to improve their portfolio with strong, diversified tenants that consistently perform, and they seek investments that provide superior risk-adjusted returns to stockholders, as well as growth and stability of their tenants. So as of December 31st, 2022, their diversified portfolio compromises 2,115 owned properties. So the bigger, the better. So as you see, for example, Rich Uncles took a hit. I took a loss. I lost some money. These guys are way bigger than these guys. I think Rich Uncles, the bricks rate was only a few buildings. And the pandemic hit and everything was screwed. So 2,115 properties with an aggregate leasable area of 59.4 million square feet across 49 states and 34 industries. So look at the occupancy rate, 99.9%, 52.1% publicly owned, 351 tenants, 9.2 billion in real estate investments, like I said, 34 industries. So here's their composition. So they have service retail, industrial, discretionary retail, non-discretionary retail. So service retail is at 42.1%. Their region distribution. So their top 5 states are Texas at 14.2%. Ohio is actually at 5.7%, which is great. Georgia's at 6% and Florida's at 7.6%. So those top 4 are pretty strong. So there's a few things. Here's some of their tenants. Lifetime Fitness, they have 12 properties. Invited Clubs, 21 properties. So based in Dallas, Invited Clubs is the largest owner and operator of private golf and country clubs across the nation. They have 11 properties in BJ Wholesale Club. At Home, they have 16 properties. Dave & Buster's, 15 properties. 160 properties of Church's Chicken. 132 properties of Dollar Tree / Family Dollar. 8 properties of Home Depot. 75 properties of Circle K. And 107 properties of GPM. So that's one thing that's very attractive. So they're well diversified. And again, the occupancy rate is 99.9%, which is very strong. Now let's go over their revenue, FFO, and dividend history. So check out their revenue. This is in millions US dollars. This is annual revenue. 2016, 435. This is on macro trends. 2017, 431, a little bit of a dip. 2018, 445. 2019, 516, 2020 pandemic hit, ouch, 483, 2021, 608, and 2022, 709. So 2016 to 2022, there was a huge increase in revenue. So let's go over their FFO real quick before we jump to their dividend history. So I'm on seekingalpha.com for the article. So they generated a net income share of 48 cents, FFO share of 87 cents, and AFFO per share of 88 cents. They invested $350 million in acquisitions and revenue producing expenditures, generated $134.8 million in gross proceeds and dispositions, and issued 1.6 million shares and net proceeds of $63.9 million. So they're right here, their highlights: generated net income of 48 cents versus 34 cents per diluted share, FFO per share of 87 cents versus 88 cents, and AFFO per share of 88 cents versus 85 cents. So, okay, so here's a few things. Right here, they invested, like right here, the cash capitalization rate of their investments at 7.15%, acquisition of 24 properties across 16 transactions with a weighted average lease term of 15.6 years. So according to the article, they their FFO of 88 cents missed by 3 cents, but net income per share, I'm not too upset about that with the recent news out there because their revenue is done very well. They have really good tenants, and I'm going to show you their dividend history, which is unbelievable. So check this out. In 2019, it was slowly going up, 13 cents to 63 cents, and it was a little stagnant with the pandemic. But then 2021, it jumped to 64 cents to 66 cents. So payout ratio is 74%. Number of dividend increases in the last 5 years is 4. Dividend growth in 5 years is 24.20%. So if you bought 1 share, you made $265 with a 6.81% dividend yield. The dividend growth is very strong. The revenue has jumped up. I do believe that these guys are a strong dividend stock. Dividend growth is pretty strong. I wanted to go over that. The revenue is pretty strong. Remember, 90% of what you make as a real estate investment trust has to go back to investors. That brought my confidence up strongly. And they're acquiring new companies, they're a landlord to more companies. They're starting to get more leases out there and more acquisitions, and boom. I mean, they're getting bigger, stronger, and more powerful. And I really like these guys. These are why I'm long in these guys, and something drastically would have to happen. And plus, their dividend growth in 5 years is 24.20%. I like that, and I can't complain. And with their revenue going up, usually the board of directors feel pretty confident to hike the dividend and go from there. Of course, there's no guarantees. This is not financial advice I'm giving you. I just go over the trends, and I provide my rationales as to why I like certain dividend stocks, or if certain dividend stocks are on my radar, if they're good, they're hot, I don't like them, or why I buy them. So I'm very transparent on my channel. Of course, Again, I'll repeat this. This is for entertainment purposes only. I'll have a video for you guys tomorrow. I hope you enjoyed this video. And you guys take care and have a great Thursday.